So this is the first in a new series where I go over opportunities. So as I see a beautiful, generally safer opportunity, I'm going to make a video on it. And like everything else, I want you to do your own due diligence. You'll have to agree with me. I prefer you to use these videos as an entry point, do your own further research, and maybe you buy the same equity, maybe you don't. So in this case, we're going to talk about the oil sector. And specifically, we're going to go over Oxy, Chevron, and Exxon. So those three right there, and kind of grade them amongst each other and see which one is the best for you. Because I'm actually going to finish this video not telling you which stocks of the three I'm buying. So it's very important to me that you do your own due diligence. You don't just blindly listen to what I'm telling you. Now, with all this, you have WTI. Now, WTI is an indicator of the value of oil. So it's relative to the price for 1 barrel of oil. You're going to see on our chart here that last week WTI bottomed for the year. Now, oil and gas, like the airlines, are what's called, these are cyclical sector stocks, which means they're beautiful stocks for swing trading, where you can pretty much buy and sell the stock over and over again pretty easily as long as you have very smart entry and exit points. Now, as you can see here, this is the 3-year WTI, which shows just how cyclical oil really is. All three of these stocks are going to perform largely based off WTI. Obviously, the companies themselves are a little different, and they'll have their individual strengths and weaknesses, but they're going to generally have their tops when WTI is having a top, and their bottoms when WTI is at a bottom. Right now, WTI at a bottom presents a wonderful buying opportunity for all of these, but you kind of narrow them down a bit more to see which ones you really want to buy. So we're going to break this down in this video amongst 4 different categories. So all 4 of these, Cat 1, RSI MACD, my 2 favorite technicals. Cat 2 is growth, Cat 3 is evaluation, and Cat 4 is a dividend. I include dividend on here because technically, if you really wanted to, you could buy the stock and sell it over 365 days from now for a nice little long-term capital gain. While you're doing that, you can collect dividends. Especially Chevron, as you're going to find out, is a dividend aristocrat. Both Chevron and Exxon are, but Chevron is one of the best ones in the game. So pay attention to dividends. They do pay out quite a bit, especially if you like to have your horizons more on the multiple year scope. So starting with RSI and MACD. Now the MACD histograms for all 3 of these are going to be very similar. So with MACD histogram, I'm really focused on waiting until the MACD histogram curls to start focusing on the entry point. The curling MACDs are in play for all 3 of these, which is why when we're focusing on the technicals here, RSI is a bit more useful. Now RSI for a cyclical stock is super easy. You buy on the oversold, you sell on the overbought, or close to the overbought, or close to the oversold. Very simple. Relative strength indicator, name the game for this kind of stuff. And right now, of these stocks, the only one with the oversold condition is with Oxy. So that's a huge plus. Now, Exxon is close. As you can see, RSI, it's pretty low here, but not as oversold as Oxy. Likewise, MACD histogram almost the exact same. These stocks mirror each other quite a bit. Now, Chevron and Exxon are almost exactly the same for technicals in this case, where the only difference is in 2 ways. One, the MACD for Chevron is much less dramatic than Exxon or Oxy. It's a lower beta stock. And with beta, As the beta increases, it tells how volatile a stock is. So Chevron, lower beta stock, and doesn't have quite as much price action as the other guys. Now, the RSI is also shooting up a little faster with Chevron. Now, I want you to pause the video. And doing so, I want you to make an order of Oxy versus CVX versus Exxon. Just on MACD, but really mostly on RSI. Pause the video in your head and kind of orient these three, and then continue. So for my answers, I'm having Oxy first. That's the by far the easiest to the RSI in the oversold category. Chevron and Exxon almost the exact same. So I'm putting Chevron 2 for here, but they're nearly identical, so it's pretty hard to actually grade those two. All right, so now I'm gonna go over growth. Now I'm going to do this over 5-year, current quarter, which / current year, and next year. Now, in the case of Oxy, it's a very interesting one. Oxy is the only one that's actually growing this year. Now, 0.27%, not very good, but better than negative. So the other two are negative, so helps Oxy out in this one. And they're going to kill it next year. So next year, looking at almost 25% for the year. This projection could be wrong. That's pretty good. Now, unfortunately, Oxy has not had a very good 5 years, so only about 8.5, and not getting the benefit of the doubt here. So the Zacks here, which I got this data from, Zacks is just not using an actual projection for that 5-year, and the PEG ratio uses the 5-year growth. So right now, PEG ratio is NA because we're not sure how good Oxy will grow over the 5-year. But considering the environment for WTI, pretty good for 2024, and they should kill it next year. Now, when it comes to Exxon's had a pretty rocky current year. So -12. Now it's interesting, of these three, they're the only one that actually have a quarter-over-quarter increasing EPS, because the last quarter was pretty terrible. So that top portion on Zacks would tell how the company's done relative to the previous quarter. So earnings per share was better than previous quarter, but overall the year is pretty bad. So -12, not very good. Now next year, not very good either compared to the other ones. So they're only going to grow about 10. But remember, Exxon of these three is an extremely developed company. It's going to have slow growth. And this is kind of how it is. Now, Exxon was a mighty next 5 years of a 3, which is very unlikely. I don't really like these projections all that much. But if you're going to use that projection, let's get a PEG ratio of 4.43, which is probably inaccurate, by the way, but whatever. Now, if we look at Chevron, assuming the actual PEG ratio is correct, they're at a 2.43. Now, that 2.43 in this case is derived from next 5 years with a whopping 5. Stock's not very good, but we'll see. I am not too confident of these numbers at all. I will say though that Chevron has a pretty strong next year growth. So if they're going to hit maybe a full 25% next year, that's pretty good. So I'm pretty happy with that. Remember, this is a safer bet company than Oxy is. So 25% growth in the next year is pretty awesome. interestingly, the current year is roughly the same between Chevron and Exxon. So they've both done pretty poor, and only Oxy is the only one that actually has positive growth for this year. Now, once again, I want you to pause the video. I want you to decide for yourself, Oxy or Chevron versus Exxon. Break it down by this year, next year, overall. So for my answers for growth, is pretty easy because you can just look at the slides. But current year, Oxy, only one positive. So wins by default, then Chevron the next one. Now next year, Chevron, lowest favorite company, then Oxy. Chevron's first. Oxy's pretty good. They're almost identical. So Oxy second. Exxon, unfortunately, has a significantly lower amount of growth projected than the other two next year. Overall, Oxy's best growth-wise, then Chevron, then Exxon. Now valuation. So valuation, pretty easy here. Now it's interesting when you use Zacks. Zacks is putting Oxy in a different category than Exxon and Chevron, but it's whatever. Now, knowing this, Oxy is actually a PE lower than the industry average, while Exxon and Chevron are higher. It's worth mentioning that Exxon and Chevron are going to almost always trade rich relative to the overall oil sector because they're the best of the best. Just how NVIDIA trades rich. So when you are the best company, you're going to usually have a P ratio above the industrial average. Now, PS, price to sales, PB, price to book, both very, very low. So these guys are hardcore revenue kings. It's worth mentioning that Chevron actually has a lower PS. Now, PS is just like PE, but in this case, you're going to focus on total revenue rather than total earnings. So 1.31 is pretty interesting there. Now, the analyst price targets are all kind of, they're always monkey-ish. I don't put too much weight in this, but they do provide a kind of a nice little gauge in your toolbox for valuation. So Oxy, if you hold it a year from now, could go anywhere between 11 to a 74% gain. Hold Exxon for a year, you could lose money at -1% or gain 41%. And Chevron, you could gain 9.5 to all the way to 45.8. So very interesting here, the price targets. And price targets are tricky too because every single earnings is going to have new price targets. So price targets are always going to reflect the latest earnings. Dividends. Exxon and Chevron in particular are dividend aristocrats. So Chevron are a beautiful 6.52%. So of these three, Chevron is the easiest to buy when it is very low, as it is right now, and just hold it and collect that juicy 6.52% dividend. Now, Oxy is the smallest dividend, but it's the best growth stock, and that's usually how it plays out. So weaker dividend, rock star growth stock. There you go. Excellent, kind of in the middle there. So overall, what order would you put Oxy, Chevron, and Exxon? This is your list. I am not telling you what stock I'm buying tomorrow. So that's your question. Because I'm gonna buy two of these, but I'm not gonna say which two. I want you to make your own list, do your own due diligence, and believe in yourself. Name of the game. I'm not doing investment advising. I'm just an analyst. Have a great week, everybody.